Yeah, hi, this is Kevin Gormley, a CPA that does financial planning, and today we're going to talk about winning the loser's game. And I don't know if you've ever felt like investing is like gambling, whereby you're putting your money into stocks and bonds and you're trading and you lose money. Well, I just read a book over the weekend called Winning the Loser's Game, Timeless Strategies for Successful Investing, and it's by Charles Ellis. I recommend the book highly. If you want a copy, I'll be happy to send it to you. But Mr. Ellis really talks about how investing used to be a winner's game, and that is that if you studied and you picked out the companies and you really worked real hard, well, you could win at investing. And in 1960, 10% of all the money invested was invested by institutions, that is money managers and people that really understood investing, and 90% was retail money and other money. Today, that's changed. In the 2014 time period, almost 90% of the money is invested by institutions, pension funds, 401ks, and only 10% is retail. So if you're trying to buy and sell either individual stocks or mutual funds, you are investing against the pros that spend all their time looking for inaccuracies in the price of stocks and mutual funds. And that's the reason why you're probably going to lose this game. And what Mr. Ellis says to do is to, why not win at this game? And the way to win is to select index funds. And the reason why index funds are so good is that if you think about the dream team that you could choose, if you could choose a dream team in investing, you would probably pick people like Warren Buffett, Charlie Munger, Peter Lynch, and others. If you picked all these people and had them all on your dream team, they make up the market. And so the collective wisdom of all these great genius investors is actually in the market. So when you invest in index funds, especially broad index funds, you are investing with the genius of these people. When you try to pick mutual fund managers, one manager, they're going up against the other 90% of the people, and it's very, very hard, if not impossible, for them to beat the market. And after fees, they're surely going to underperform the market. So in essence, what I would say to you is be well above average with investing in index funds. They cost less. You get to pay less taxes. You get to keep more of your investment money. And 75 to 85% of the mutual funds that you will invest in will underperform these indexes. I don't know about you, but 85% is well above average. It's really fantastic. So put your money in index funds and then stay invested. That's the second part that Mr. Ellis says is the way to win the loser's game is to not sell when the market is down, not buy when the market is high, not get excited about different sectors of the stock market. Like right now, pour into things that have been doing well. Just keep invested, slow and steady, not exciting, and you too can win the loser's game. Thanks for watching.
To solidify what Kevin just said, here's a chart that shows the percentage of active public equity funds that were outperformed by their benchmark, which of course is the market. When I think what is average out of 100%, I usually think 50%. A lot of times people associate investing in index funds with getting average performance. This chart shows that by choosing these quote-unquote average index funds, you will be outperforming active public equity funds or stock pickers over 70% of the time in almost all major equity fund categories. This shows to me that by choosing index funds, you are winning the loser's game.